All right, welcome interns. We're going to jump right into a concept that is absolutely fundamental to your careers, consolidation. We're going to pull back the curtain on what it is, why it's so important, and how we apply the Australian standard ASB 10. So this is the big question that consolidation really forces us to answer. You might look at two companies that are totally separate on paper, legally distinct. But are they telling two different stories, or are they actually economically just one big story? The rules are clear. If one company controls the other, their financial story has to be told as a single unified narrative. So here's how we're going to break this down. First, the why. Why do we even do this? Second, the big test that tells us when we have to consolidate. Third, the specific philosophy, the how we do it. And finally, we'll see what it all looks like in practice.
Okay, let's start with the big picture. Why do we go through all this trouble of mashing financial statements together? What's the point?
The best way to think about this is like taking a family portrait. You've got several individuals, right? Each one is their own person. But the portrait, it doesn't just show a collection of people. It tells the story of the family as a single unit. Consolidation does the exact same thing for a group of companies. It's about presenting that one single economic family.
So here's the formal definition. And the key phrase here is, as those of a single economic entity. This is so important. It means we don't just add up all the numbers. We have to go in and get rid of any transactions between the companies. And why is that? Well, think about it. You can't make a profit selling something to yourself, right? A sale from a parent to a subsidiary is just like moving cash from your left pocket to your right pocket. From the group's perspective, nothing has actually happened. A real transaction only happens when the group sells to someone on the outside. Now, like with most accounting rules, there's an exception to keep in your back pocket. It's for investment entities. These are companies whose whole business model is just to invest for returns. They don't have to consolidate. Instead, they just measure their investments at fair value, basically what it's worth on the market today, and any changes in that value go straight to the income statement.
Okay, so we know why we consolidate. Now let's dig into the absolute non-negotiable rule for when you have to do it. This right here, this is one of the most critical principles in all of accounting. It's called substance over form. It means we don't really care what the legal paperwork says about ownership percentage. You could own 49% of a company, but if you're the one calling all the shots, appointing the CEO, and setting the budget, you're in control. It's all about who is actually steering the ship. So how do we figure out who's in control? Well, IFRS B10 gives us a very clear three-part test, and you have to meet all three of these conditions. Number one, you need power. That's the right to direct the activities that matter. Two, you need exposure to variable returns. This just means your own financial results go up or down based on how the other company performs. And three, you need the ability to use that power to affect your returns. It's the combination of all three that equals control. Okay, so we've got the why and the when. Now let's get into the how. This is the philosophy that drives the actual work you'll be doing. Historically, there were a few different ways to think about this. One was the proprietary concept. This is a very parent-focused view. It says, hey, if the parent owns 70% of a subsidiary, then we'll only bring in 70% of its assets and liabilities. That other 30% that belongs to other owners, it's just completely ignored, left out of the picture. Then there's another approach, the parent entity concept. This one's a bit different. It says, okay, the parent controls 100% of the subsidiary's stuff, so let's bring it all in. But it then treats that 30% owned by outsiders, what we call the non-controlling interest, as if it were a liability, almost like a debt the group owes to those other shareholders. Both of those ideas kind of make sense in their own way, right? But the standard is very, very clear. It actually rejects both of them and demands a third, more complete perspective. The required approach is the entity concept. This is the one you have to know. ASCB 10 insists on it because it gives the truest picture of what's actually going on. It says that because the parent controls the entire subsidiary, we have to look at the whole operation, the parent, the subsidiary, and even those outside owners, as one single cohesive economic unit. This table just lays it all out perfectly. Just focus on that top row, the entity concept. See? We include 100% of the subsidiary's assets and liabilities, and the non-controlling interest, the NCI, it's treated as a part of the group's total equity. Those other owners are seen as co-owners in this big economic family. It's so different from the other two concepts, which either ignore them or treat them like a debt. So theory's great, but let's see how this entity concept actually works with some of the key mechanics you'll be dealing with day to day. This little diagram shows it all. Company A has a 70% stake, so it's in control. But under our entity concept, that other 30% isn't an afterthought. Those owners are recognized as the non-controlling interest, or NCI, and they are a vital piece of the group's equity story.
And here's the formal lingo. But the main takeaway for you is this. Because we see the NCI as co-owners, their slice of the pie is presented within the equity section on the consolidated balance sheet. I'll say that again. It is not a liability. It's a special category of equity.
Okay, goodwill. This is a big one. When a parent buys a subsidiary, they often pay more than the fair value of all the individual assets they're getting. So why pay a premium? Well, that premium is an asset we call goodwill. It represents all the valuable stuff you can't see on a balance sheet. A killer brand, an amazing corporate culture, future growth, that kind of thing.
And figuring it out is actually pretty simple. It's a 3-step dance. Step 1, figure out how much you paid. Step 2, figure out the fair value of what you actually got. Step 3, the difference between those two is your goodwill. It's a new asset that pops up on the consolidated balance sheet, capturing all that unidentifiable value. Finally, when you're sitting down with your Excel sheet, these are the big journal entries you'll be making. You'll get rid of the parent's investment asset and the sub's equity, so you don't double count. You'll put any goodwill on the books, you'll show the NCI's share of equity, and of course, you'll eliminate all those internal transactions, so the final report only shows what the group did with the outside world. And this really brings us to the core of it all. The entity concept forces you to change your perspective. You stop just looking at the parent slice, and you start seeing the entire economic group as a single thing. It's not about owning a piece of the pie, it's about controlling the whole pie. And let me tell you, truly mastering this concept is going to be a cornerstone of your success as an accountant.